Hi.
Perfect, great.
Hey, Marty, I'm here. Yeah, just let me know when you want me to get started, and I'll be glad to do so.
Great. Why don't you turn your video on and you can introduce yourself to the group, and then you can get started after a quick introduction.
I'm pretty certain they don't want to look at me. They barely want to listen to me. But I'll humor you guys and let you look at me. Let me share my screen here.
Do you want to do a quick intro while you're doing that?
Yeah, sure. Yeah, yes. Thank you, Marty. Appreciate you setting all this up, and thank you guys all for joining us. My name is Oscar Torres. I am the co-founder and CEO of Tower Rock Oil and Gas, and I'll go into my history here shortly. My main goal here is to talk to you guys about the mineral and royalty space, and why not only is it a great investment vehicle, it's also one of the best times ever to invest in this space. The main takeaways, aside from that, should be that our portfolios combined yield generation in the form of free cash flow from royalty income, excellent upside from development, protected downside from the hard assets, and all combined to make this a unique alternative asymmetrical investment opportunity.
Perfect, great. And you're going to give us a quick rundown of where oil and gas is right now, and then also what are the opportunities for investing in royalties.
Yeah, yeah, I'll go through as much as I can about that, and I actually am operating under the assumption that most people know that oil's in a downturn, much like the entire market is, but we'll cover all that. First, want to make sure that everybody understands this disclaimer.
Are you able to share your screen with us?
Are you not seeing it?
No, I don't.
Okay.
Oh, there you go.
So sorry about that.
Perfect, great.
You were supposed to see this. Now we're at the disclaimers. Sorry, that kind of took me out of my mode here. Anyway, well, when it comes to the mineral and royalty space, you're not really going to find very many people with as much experience as me. I've been doing this for 20 years. I began my career shortly after graduating from the University of Texas here in Austin, Hook'em Horns, with a degree in petroleum engineering. And I was fortunate enough to be hired by a small mineral and royalty acquisition startup. We navigated some pretty volatile times across my 13-year career there, and you can see that in this chart right here. And Marty, are you able to see that I'm on this chart? I just want to make sure that
I see a mineral royalty chart. Yes, looks pretty good.
Good. Okay. Across my 13-year career with my previous firm, I helped generate over $240 million in value, including $90 million in net income. And since my departure in 2013 and the founding of Tower Rock, my team and I have generated outstanding returns as well for our partners, while navigating quite a bit of volatility as well. I will go into that more detail about that shortly. But overall, across my 20-year in the very volatile industry, I've been involved in over 4,000 transactions totaling over $120 million. And I'm certainly well aligned with the success of our funds and that of our limited partners, particularly considering that I do not pay myself a salary, and 80% of my net worth is tied to these entities and these funds. Last but not least, my business partner and I have built a team with over 50 years of combined experience in the sector. to help us navigate and to help us invest every single dollar and put it in the best position to succeed. So what are mineral rights and why should you care? Well, for one, they are hard assets. Mineral rights are essentially real estate below the ground. They are generally uncorrelated to the markets. And I know it seems that with this black swan, everyone was hit pretty hard, but I'll do my best to explain how our portfolios are insulated from losses as extreme as those seen by other sectors. One of the primary drivers of that insulation is that mineral rights require no capital expenditures beyond the original acquisition cost. So you're always working with free cash flow from production royalty payments. So I like to make this analogy. Imagine owning a commercial or rental property that you lease out to someone else, and they take care of every single expenditure involved with it, including anything that improves the value of the property. As a matter of fact, they're actually motivated to make improvements so that they can charge more rent. Nice new hardwood floors, new roof, new appliances, all so that they can increase profits and to boot, they cut you in on the increased monthly revenue. Well, I mean, that's essentially it. I realize I'm oversimplifying a little bit, but I bet most of you get the picture, particularly those of you familiar with ground leases in commercial real estate. But anyway, I digress. When comparing a mineral portfolio to other investments, there's really not many others like it. We have yield, we have free cash flow, hard assets, tax benefits from depletion, 1031 exchanges, minimal property taxes, generally low risk, high upside. Properties in our portfolios have annualized yields ranging from 4% to 30%, and then total ROIs from 20 to well over 300%. And lastly, but well worth noting, is that mineral rights are generally owned in perpetuity.
Hey, Oscar, how predictable are these royalty streams? Is this analogous to what you have in healthcare? You know, when somebody licenses their technology to Pfizer.
Good question. Let me get to that in just a minute, if you don't mind. Hang on one second. We're having technical difficulties.
If you're having bandwidth issues, you may want to go to. Hey Hank, how are you? If you're having bandwidth issues, you might want to just turn off the video and just go audio only.
I think I'm good.
Okay. But we don't see your presentation.
I know. Give me one.
You got to start sharing it again.
Yep. Give me 1 second. All right, we back?
I don't see it. Oh, now I see it. Okay, here we go.
Right.
We're back. Thanks.
All right, so I will get to your question, Marty, if you give me a minute. But before we go any further, I do want to address the elephant in the room, which is, you know, when I talk about low risk, how on earth could you call an oil and gas investment low risk? And this is a pretty simple analogy. If you look at conventional vertical drilling, which is what many people are used to seeing, you got one well that's drilled vertically, that's chasing the jelly, and that's considered pretty risky in my world, in my space. Doesn't mean we don't invest in existing production from vertical drilling, but we generally are not underwriting, and we're not putting value on anything like that. What we're looking at is more unconventional horizontal drilling exploitation, which you guys are used to seeing here in the news and everywhere else, which involves the hydraulic fracturing and horizontal drilling. And that is happening in areas that are more like tiramisu. You know, there's layers upon layers of goodness, and that goodness being oil and natural gas. So when you think about those areas, the operators that go into those areas are generally going to drill several wells at any point in time. So your exposure to a dry hole is minimal, if any. So now I'm certainly not saying that a dry hole is the only risk associated with the assets we acquire. There are plenty of other factors to consider, including the obvious one staring us in the face today, and Marty alluded to, and that's low oil prices, oil and natural gas prices. So the reality is that there are various factors that we can't control, and we tend to focus on what we can control. In a book called The Intelligent Investor, which Warren Buffett calls the best book on investment ever written, the author says, the essence of portfolio management is the management of risks, not the management of returns. And all good portfolio management begins and ends with the same premise. So to that end, our general portfolio and its components, what we are compiling and ultimately building, when plotted on a return versus risk profile, would look something like this. Keep in mind that with every asset purchase, we try to capture an organic value that stems from how we generate the lead internally compared to what we could get it if we sold it in the retail space. So for example, if we bought something from John Smith and we were able to sell it at an auction immediately, there's an immediate arbitrage that we capture. So while our assets fit somewhere above this risk return line here that separates the blue and the white here, collectively, they improve position on this chart via organic upside. So drilling or any activity that drives up cash flow and value, and also via delivered downside protection, meaning syndication of any acquisition or sales to balance the portfolio. So simply put, we're actively managing our assets and aiming to make sure we're mitigating risk and maximizing value wherever we can, with ultimately wanting.
Oscar, just to clarify, are you buying the asset, or are you buying the royalty stream?
So great question. We're buying. So if we're going to talk about what an asset is, the tract of land that each of us is standing on has surface rights, and it has mineral rights, and it has air rights, and it has. So we're buying the tract of land that encompasses the minerals. We don't buy surface by itself. So we buy the minerals associated with the tracts of land. So the royalty stream comes with that asset, right? You can split up the royalty stream from the asset, but we don't do that. We buy the asset and the royalty stream comes with it. And when we talk about an asset, it is a tract of land. It is a mineral tract of land. So that's what we're always talking about, how these are hard assets. They're very much compared to real estate and in more ways than one. So great question, Marty. Thank you for asking about that. And when I say we own these into perpetuity, if the royalty stream stops, we still own the minerals. So it's a very good point of distinction. And again, going back to this little chart here, the overall portfolio is going to be worth more than the sum of its parts, and it's one that we hope will have a high return on investment and composed of very low risk.
And just to clarify, you're not the operator, is that correct?
That is correct. That is exactly right, and we'll touch on that again here in a minute. So how does our acquisition strategy? Again, going back to that acquisition strategy, it's repeatable, scalable, and it's proven to protect downside. So no, we do not have any capital expenditures at all. Once we buy the asset, we're no longer putting any more money into it. We are, on the other hand, we're receiving that royalty stream, which is why I compared it to having somebody come in and buy your property. And have them spend all the money to put in the hardwood floors and all that stuff. They're doing all that stuff. They're the ones drilling the wells. They're the ones that are pumping the oil out, and they are aligned with us to make us more money. So again, our acquisition strategies has been proven to protect the downside via the diversity. They provide upside from the development, and then obviously in a time like this, there's also additional upside from commodity pricing, because we're gonna buy something underwriting a very low oil price, which relative to what history has shown is bound to go up. And at what point is a different story, right? But they will all yield free cash.
Oscar, there was a question by one of the audience members who was asking, he says, explain if royalty payments can be suspended if the well operator decides to shut in the well.
Good question. Generally speaking, yes, an operator can suspend a royalty payment to and not so that they don't have to sell the oil right now. But it wouldn't behoove them to do that. There is a lot of talk about prorating production right now, which is obviously very possible. It hasn't happened since the 80s. But that's going to end up hurting a lot of people. And with these leases, when an operator leases a property from me as a mineral owner, they pay me a bonus right up front to lease it from me. And then during the course of that lease period, they're required to drill a well if it's not already producing, obviously. And then they drill that well, and after they drill that well, the lease is held in perpetuity until it stops producing. So if they shut in the production, they lose that lease 90 days after it stops producing. So it doesn't behoove them to do that, and it has to produce in commercial quantities too. They can't just produce a barrel a day and then just kind of just figure out a way to keep that thing going. It has to be producing in commercial quantities, or they will lose that lease. And it's very valuable.
So it's almost like a non-performing asset.
It's exactly right. It's exactly right. And if they did that, then obviously that could be good for us, because as the mineral owner, then we have the opportunity to drop that operator who's clearly not doing their fiduciary duty. I wouldn't call them fiduciaries, but they're not doing their duty to maintain our lease and keep making us money, so that we can then, we're free to lease that to whomever else we want. Or if we wanted to, we could go and produce it ourselves, but we don't. We're not in that game. So great question, and we'll actually touch on that again a little bit, but it was a good point to do that. So going back to this acquisition strategy, we acquire thousands of acres and hundreds of tracts of land with varying degrees of risk and profitability. So going back to this return versus risk profile, the assets with the least amount of risk generate cash flow from legacy production. You can see down here, number 4. They're not likely to have much in the way of new drilling. It's not impossible though, and because we own the minerals to the center of the earth, new technologies or new development techniques or anything like that in the future would certainly benefit us if they were applied to any of our lands. So any property that we buy that has currently producing wells, we carefully handicap the risk of the production ceasing, just like the question you guys just asked. If it's a rinky-dink operator that may not be able to operate this well at whatever oil price we're underwriting, then we will factor that into the risk profile and how much we pay. And then we we handicap that production, we handicap that cash flow, and we appropriately discount that cash flow. Over here on number 3 is the opposite end of the spectrum. It's where it's all upside, it's all non-producing, and that's where the smallest percentage of the properties we buy are located, but they also provide the biggest upside, because we buy them at a much lower price point, discounted cash flow analysis, or from a discount.
What locations are you looking at? What's your geographic footprint?
Okay, so another good question. When we're talking about the number 4 here, cash flow producing properties, we're buying all over the country, all over the continental United States. We do focus on good properties. We're focused on good value is what we're focused on. From a PDP perspective, so in other words, from currently producing properties, for the properties that are in all upside over here with number 3, they're considered the riskier assets, so the ones where we're actually underwriting future development. We're focused in areas that have very active rig counts. So historically, that has been for us primarily the Delaware and the Midland Basin, which are in the Permian Basin, West Texas. But we'll also look at areas with natural gas, Haynesville, for example, the Utica, the Barnett Shale. And we also look at the Eagle Ford. we'll look at areas that have great rock that are offering us good value, and that are with good operators, that will withstand the test of any downturn like the one we're seeing now. So another great question. Sounds like we've got some good people here, smart people. Doesn't surprise me listening to our cast here. We do also hedge as warranted and when necessary. So right now, actually right after this, I will actually be on the phone talking to a couple of bankers and trying to figure out what our hedges are going to look like for our existing production and for some of the production that we're buying here in the near future. So I hope that answers kind of more the question. And again, with 1, 2, and 5 here, it's somewhere in the middle. And it also, one thing I forgot to mention, I'm sorry, is syndication becomes a pretty good component of how we de-risk our portfolios. If there's an asset that is particularly large in size as far as how much cash we need to purchase it, we will seek a deal share partner, somebody that's in the industry also, and we will syndicate a third or a half or a quarter of the deal to them, depending on the level of risk, and we will have them pay more. We pay a premium for their portion. So a good example is if we buy $1 million asset, we will sell 50% of it for $600,000, and we'll keep the other half for $400,000, and we will use that additional cash to go out and buy more properties and do that. And that's all with the goal of trying to build that diverse portfolio.
So what percent of deals do you look at that are already drilled wells versus that already have drilled wells on them versus green fields?
Good question. So this good question. So this is going back to this chart right here, the 50-40-10. That's about the breakdown that you'll see from here. So it's about 50% of what we buy is really strictly producing assets that are generating a good royalty stream. 10% will be made up of these riskier, all upside type assets, and then we'll have everything in between, a mixture of everything in between. And again, there are certain elements that will move, that will shift these classifications more to this low risk, high ROI portfolio combination. And those elements that I was talking about are the organic upside, the deliberate downside protection, and then that organic retail arbitrage that I discussed, where the second we buy it, it's worth more than in the retail space than what we pay. All things being equal, obviously, I'm not going to sit here and tell you that a property we bought with an average of $55 oil 6 months ago is we could go out and get a retail price that's much higher right now in the $30 space. But we're also not selling it right now, right? I mean, we're holding on to it, and I'll touch on that in a minute. Did that answer your question, Marty?
Yeah, that's a great answer, and I'd love to hear about how you exit out of these purchases, if you exit, etc.
Yeah, well, yeah, certainly we will get to that for sure.
We have about 8 minutes to go, by the way.
Sure, I'll get there, I promise. So going back to that syndication, going back to all of the de-risking, using the strategy of buying good rock and buying good acquisitions, we are able to beat the curve. Okay. We're all able to win far more than we lose. And going back to the prediction of prices, a good Warren Buffett quote that I kind of modified is, our circle of competence does include the ability to predict oil prices a day from now, a year from now, or 5 years from now. It's the same as predicting what the economy is going to do, what the stock market is going to do. I can't do any of those things, but what I can do is do well investing over time. So that's what we do. And you can see here that, if you pardon the busyness of this slide, the green is the oil price, the oil price that you saw here, and then what we all have done here is charted every one of our acquisitions from April of 2014 to April of 2019, and you can see that everything's up and to the right for the most part. We've got a couple here that lost over a long period, but what I didn't chart here. This is return on investment only on acquisition and sale. This isn't exits, portfolio exits. These are just individual acquisitions that we sold. And you can see that a lot of these go against the grain. You can see that oil prices are dropping and we're still making money. And my point to showing you this is that it's just that we have, over the years, we've been able to successfully make a profit, generate profits, despite whatever oil prices are doing. I'll touch on this really quickly. I think it's worth noting what our first two funds have done. Fund one was $1.8 million in limited partner equity. They were very small. This one kind of got us off the ground. We've distributed over almost $3 million through 2019. The current market value is actually outdated, so you'll pardon me for not having updated some of these values in the last 2 or 3 weeks. We're shorthanded, but the average rate of return across that 5 years has been 26.5%. The projected ROI of 3.3x, I would say, is still pretty accurate, because we're not at a position right now where we have to sell anything. So what we'll do is we'll just hold on to these assets and wait and wait out this downturn. We'll just continue to distribute yield and wait it out. Fund two was a bigger fund. It was $10 million. We had $3 million in debt. We've distributed $3.5 million to date. And again, as of 2 or 3 weeks ago, we were at about $19 million in current market value. The average rate of return during those two years has been about 15%. And if we were to exit, if we had exited 2 or 3 weeks ago, at a 2x, we would have been looking at a 54% IRR. Obviously, that's not happening. Going back to what I was saying before, we now have the ability to just, this is the modeling, not modeling, but kind of showing what Fund 2 would have looked like here at an asset value, or I'm sorry, at a base case of $55 oil. And now we're looking at $30 oil, and you can see that drop in royalty cash flow and asset value. But overall, again, it's one of those things where we don't have to sell it. We have no capex. We have no reason to sell it. So we will just continue to distribute yield, and we'll remain in quote unquote wealth preservation mode while we have $20, $30 oil and distribute these lower yields while oil and gas reserve depletion slows down. So I think it's important to kind of understand that we, not being in a position where you ever have to sell, allows you to ride out these downturns and still distribute yield.
Oscar, we've got a few minutes left.
Yep, no, gotcha. I've got 2 slides left. So obviously I can share this slideshow. I'll update a little bit, and I'm happy to share it with whomever wants it. I've actually got an appendix that will show significantly more technical stuff for anybody that wants it. Just
we'll send your contact information to the group.
Yeah, we'll definitely do that. So what are we working on? We're still continuing to raise Fund 3. Fund 3 is our target goal is $12 million. We're going to keep it open for about 90 more days. We're about a year into the distribution. We've raised nearly $7 million, spent a little over that. And we've generated great value, bought great assets, and our cash flow continues to increase. We are starting to think about what we're going to do for Fund 4, which will begin upon completion of Fund 3's deployment period. We are in the early planning stages of that, and Fund 4 will involve some type of immediate yield generation. The potential deal structure there would be a debt to equity or immediate pref or interest payments, as well as participation in upside for all new acquisitions, and it'll be protected with existing assets and new assets. So anyway, that's really it. I seems almost like a buried the lead here, but I did want to make sure, and I went through the process and the concepts. I do feel like we are right now in one of the best times ever to buy. Certainly in the last 11 or 12 years. It's one of the best opportunities to invest, and many people in and out of the industry will need liquidity. And our goal is to continue to adjust our pricing decks and to coincide with industry outlook, and continue to buy solid assets that will generate yield, protect downside, and provide upside. So thanks for your time, and I mean that's generally it.
Oscar, yeah, a couple of questions. So a couple of questions are, well, so there's a couple were sent over on the chat, which is, you know, how do you de-risk the mineral rights if the values of the streams are decreasing, and what about natural gas?
So say that one more time. What
about natural gas?
No, the natural gas part I
obviously,
heard, but the part before that.
How exactly do asset mineral rights de-risk if the values of the streams are decreasing?
If the price of oil is decreasing?
If the stream, right, yes.
Yeah, I got you. Okay, well, again, you go back to being in a position where you don't have to sell it, right? So I think you're absolutely right. I mean, to answer your point right now, so if we bought it at $55 oil and we're sitting at $30 oil, how can I argue that it's increasing in value? It's not. You're right, it's not. But that's why I go back to that wealth preservation mode. We sit and we wait, and we cash checks without having. You're never gonna hear from me and say, you know, hey, John Smith, my limited partner, I need you to write me a check to bail me out. It's just not gonna happen. We're gonna sit and we're gonna wait. And we're gonna distribute yield. Now that yield may go down from 15, 20% to 4, 5, 6%, but it's still yielding. The free cash flow is lovely. Historically, we've been focused on about 75%, 80% oil. That mixture at this point might actually shift simply because we do feel like natural gas has a little bit more short-term upside, just because it trades at $1.60, $1.70 right now. So even if it goes up to $2, that's a pretty significant shift. So we do have natural gas as part of the component of our portfolio.
Great, Oscar. Well, listen, we're gonna thanks so much for your presentation. We're gonna switch over to Hank Legiere right now. Hank, are you there and ready to go?
Thank you, Marty.
I'm here and ready to go. I think that hopefully this isn't overly rushed. I have a hard cutoff talking to the NIH, the CDC, and the FDA in a few minutes, and so I thought we were going to be starting a little sooner. Sure, I'm Dr. Legiere. I'm the CEO and founder. Can you do a quick intro of yourself, Hank? Can you not hear me? Hello?
I hear you perfectly.
Okay, yep, I'm Dr. Henry Legiere. I'm the founder and CEO. I'm Dr. Henry Legiere, the founder and the CEO of Reliant Immune Diagnostics and our product platform, MDBox. By training, I studied chemistry and economics at the University of California, Berkeley. Went to Columbia University in New York City for medical school, and did an immunology fellowship at Harvard, Brigham and Women's Hospital, Mass General. Worked in the special testing lab at Mass General Hospital. Started the immunology division at MIT Medical. And for the last 5 years, have been developing this platform that's an integrated telemedicine solution with remote patient monitoring, integrated with Bluetooth medical devices to allow us to do on-site employee health exams with the same quality and detail as you would get on-site in a doctor's office. So with that, I'll actually share my screen, and I'll show you what our existing platform looked like just prior to COVID happening, and then how we quickly adapted to make use or to respond to the COVID crisis. So we were already in freestanding pharmacies. We had a contract signed with Walmart, with H-E-B, with Kroger's in the Northeast, with Ahold Delhaize, which is Stop and Shop, Giant Martin Eagle. In the Southeast with Southeast Grocers, which is Winn-Dixie, Bilo, Frisky Moss, Harvey's. In the Midwest with Myers, Schnucks, Pioneer RX, 4,700 independent pharmacies. So all told, by the end of 2020, we had a launch calendar just based on signed contracts to be in 23,000 locations.